Traders, investors, and economists are all on edge this week. Why? Because the latest U.S. payrolls report could reshape expectations for the Federal Reserve and set the tone for markets in the months ahead. The Nonfarm Payrolls report, set for release this Friday, measures how many jobs were added, or lost, in the U.S. economy last month. It's more than just a jobs number. For the Fed, it's a critical signal of whether the labor market is cooling, heating up, or holding steady. Why does this matter? Because the Federal Reserve uses labor market data alongside inflation and growth metrics to determine interest rate policy. A stronger-than-expected jobs report could push the Fed toward more aggressive rate hikes, while weaker numbers might suggest a pause or even a future rate cut. Recent months have shown a resilient U.S. job market. Even as inflation moderates, employers have continued hiring. But economists warn that any signs of slowing job growth could rattle markets that have priced in stable or rising rates. According to Bloomberg's latest survey, expectations are for the economy to have added around 100,000 jobs in August. But even small deviations from forecasts can trigger big reactions in Treasury yields, stock markets, and the dollar. Why do Treasury traders care so much? Because the yield on U.S. government bonds moves in response to rate expectations. A stronger payrolls report could send yields higher, reflecting bets on further Fed tightening. Conversely, weaker job growth might push yields lower as traders anticipate a slower pace of rate hikes.
Payrolls data are a snapshot of the labor market's health. For the Fed, it's a signal for balancing inflation risks against economic growth. Traders watch these numbers like hawks because they can shift interest rate expectations overnight.
The report also has broader implications beyond bonds. Currency markets react as well. A hot payrolls number could strengthen the dollar while softer data could weigh on it. And for equities, certain sectors, especially tech and growth stocks, can see heightened volatility depending on Fed rate expectations. Traders are also closely watching wages. Rising wages could stoke inflationary pressures, making the Fed more likely to keep rates higher for longer. Slower wage growth, on the other hand, could give policymakers room to ease off the brakes. Ultimately, this payrolls report could reshape expectations for the Fed's next moves. Will it maintain its current stance? Will it signal a pause, or is there a chance for a shift in policy direction? Investors, traders, and analysts alike are holding their breath. Because this single jobs report doesn't just reflect the past month, it can influence monetary policy, global markets, and the economic outlook for the rest of 2025. As the payrolls data is released, all eyes will be on the numbers, and their ripple effects could be felt from New York to Tokyo. For markets, for the Fed, and for the U.S. economy, this report is a critical milestone. Stay tuned, because the story of jobs is the story of the economy itself.